Welcome back to another episode of Multifamily AP 360. And today's our guest is Jonny Walker from Walker Wealth Capital. Welcome, Johnny.
How you doing, Rahman? Nice pleasure to be here.
Likewise. Thank you very much, Johnny. And a little bit about Johnny. Dr. Jonny Walker is a endodontist turned real estate fund manager and the founder of Walker Wealth, where he helps dentists and business owners create passive income, grow asymmetric wealth through a diversified approach to commercial real estate and alternative investments. With that, Johnny, you want to add anything to your background?
No, that's pretty much sums up my story in 3 lines. I have a much more detailed version, but I don't want to take up too much of everyone's time with that.
Sure, absolutely. So, yeah, you have medical background, and what made you to jump into real estate space?
I'm an endodontist by trade, but my interest in real estate started from dental school. We're immigrants from Sri Lanka. My parents are poor immigrants from Sri Lanka and worked in all kinds of different jobs. My father hustled just to make sure that we had food on the table, and my mother had a job as a municipal grants clerk, which is just like an entry level in the government position, which enabled us to get benefits, medical, dental, etc. Medical and my father sometimes tried many different things. He tried different businesses that had marginal success. Some failed. He tried an import business. And when recession came, he was working as doing security, right? My parents used to clean multifamily common area spaces in the weekend, on the evenings. And I know because my brother and I used to be there. They had to watch, nobody to watch us. So we were there hanging out while they were cleaning the areas and the common areas. So later on in his life, he started to have some modest success in real estate. Stumbled into real estate. My dad is an entrepreneurial spirit. He never stopped trying. And he started getting some success in real estate. And my brother and I were both in dental school at the time. And he told me, hey, man, you need to get into real estate, right? So he gave me my first book, which was Creating Wealth by Robert Allen. And from there, I read this in my second year of dental school. And from right there, I learned about stuff like equity and growing income streams. And from there, I knew that I was going to make my mark in this world in real estate. And this was while I was in dental school. So I already knew this was what I was going to do. As soon as I graduated from dental school in 2000, I did my residency training, my postdoctoral training at NYU and New York University. And I graduated in 2008. In 2009, I had bought my first investment property. 2010, I bought another one. So I knew before I even graduated that I was going into real estate. So, yeah.
Awesome. Thank you very much. Any lessons from your medical career translating into career or into real estate space?
Plenty. There's a lot. One of the main things I learned, I started in the active arena of real estate investing because passive investing didn't exist back then. It was BC. And by BC, I mean before 2012, right? Before 2012, back in those days, before the accredited investors existed and before 506B, 506C existed, there was no such thing as that. At least to my knowledge, I had no idea about passive invest. There was no such thing as passive investing, to my knowledge, at that time. And so all I knew from the books that I read, I had no mentors, I had no guidance. I came to America from Canada. And my parents came from Sri Lanka. They immigrated to Canada. I immigrated to United States to come do my doctoral training. I came out. I had no mentors. I had no guidance. I didn't know a single person outside of the people that were in my residency. And so I blindly went into real estate without anything except with a heart full of courage and the young enthusiasm of a young man that all of a sudden is making money and from never having any money at all and thinking $100 bill was a fortune before. I still remember when I was 20 years old, I would still think $100 is a fortune. So it was all of a sudden I'm making really good money. And so I just bought what I could. My first property that I bought was, hey, my sister-in-law is going to do her MBA at Seton Hall University in New Jersey. And hey, I said, hey, what? They were looking somewhere to rent. I said, hey, why don't I buy her and her friends? I said, why don't I buy a house and you rent it from me? Okay, no problem. Found a house near the university, bought it, and they rented it. They start paying me rent. There was 4 students together living there. They all chipped in and paid the rent. It worked out really well. Cash flowing. Tenants, when they matriculated out of their program, the next group of students would come in because it was literally walking distance. And so it was never vacant. I'm like, look, this is good here, right? So I bought another one. Realized quickly that residential properties making $200 of cash flow a month is not going to do much to replace my big income. And it wasn't going to grow wealth in the way that I wanted to. The cash flows from all 3 properties that I had, I would maybe spend on a expensive dinner with some friends. So it's like, it wasn't going to make a meaningful dent. And I started ventured into commercial real estate. And my dad said, hey, look, you should look at parking lots there. I was looking for passive income, but that didn't, that term, things that I didn't have to work for and the income would come. It as a parking lot, right? Hey, you don't have to do anything. You have somebody that comes and collects the money and it's professionally managed. You don't have tenants, this and that. I said, okay. And I went out and I bird dogged and I found a parking lot that I could afford. Nothing in New York City where I was living in Manhattan at the time. So I looked in New Jersey. I was looking in Pennsylvania. I was working in Pennsylvania. So I would commute and I found a parking lot. Boom. I'm like, hey, look, I'm getting a triple net lease. I'm getting this cash flow. There's a parking lot management company. They're paying the tax. They're paying the insurance. And I'm making more money from this one small parking lot than I am from 3 or 4 residential houses. So I'm like, okay, I need to get more of these. But parking lots are not that easy to find, especially in the price range that I could afford. Then my dad said, hey, look into triple net, like the strip malls. There's triple net leases there too, professional tenants, long 10 years, and you don't have to worry about it. You just collect the income. And I'm like, that sounds good. So bought a strip mall, bought a warehouse. Slowly, I was buying one property after the other, trying to build this income and trying to build this wealth. But I realized quickly that I was also at that time working 45 hours a week. I had got to 10 properties. This is by 2016. 10 plus properties, mostly commercial, working 45 hours a week, right? 6 days a week as an endodontist. Now I have 2 young children, right? So at that time I didn't have any kids, right? My wife and I were newly married and I was hustling. I was hungry. I was working a lot. I was making great income. And the thing is, on paper, I looked very successful, but I had way too much going on, right? I had no bandwidth. I'm managing properties. I'm working 6 days a week. I'm trying to be a present and loving father and husband, and it's way too much. I couldn't even add another property. I couldn't add anything. I couldn't barely breathe. I barely got to see my children on the weekdays, right? I was up and out the door in the morning before they're up. By the time I come home at night, they're already sleeping. When I am there with them, I'm exhausted, right? I'm not able to spend the energy and match their energy. I try it as much as I can to play and do all the things that they want. And I'm fighting fires. Hey, we have to replace a roof on this property. And this tenant is causing a problem here. And you can't be present if you have all this stuff going on. That wasn't working. And that led me to discover the world of passive investing, right? Now, post 2012 in the modern era, I learned that, hey, there's another way to do this, right? I had gone through the school of hard knocks of owning and managing property. I learned about triple net leases. I learned about the pains of management. I've learned about bookkeeping, and I learned so much through the school of hard knocks. Some properties did well. Some properties didn't do well, right? So I paid hundreds of thousands of dollars of tuition to become an endodontist. And I paid hundreds of thousands of dollars to become a decorated real estate investor, right? And so this journey led me to now, fast forward, I learned about passive investing. I created a brand so other dentists could avoid all of this stuff that I went through. I said, hey, look, I'm going to create a brand. I'm going to help people. The other dentists didn't have to go through what I went through. Because after I discovered passive investing, I started selling all my active investments. I had learned in the books, one thing about books is how you build wealth in real estate is you buy and you hold on to property for long periods of time, right? So this is what my goal, I had never sold anything. I had just been buying, accumulating. Now light bulb moment, I can get all these advantages of real estate. I can build streams of income. I can build wealth. I can get all these tax advantages without while deferring to third-party expertise that can do it better than a mom and pop operator, if work more efficiently than a mom and pop operator, than an operator that has a team in place, that does it full time, that has 20 full-time employees. They have the software, they have the accounting, they have the legal teams, right? They have umbrella policies and insurance. As a mom and pop operator, you cannot compete with those people, right? So for me, I know that I can get all these advantages and defer to somebody that's doing it at a highly professional level. And I can build what I'm trying to get is income, right? Passive streams of income so I can replace my need to depend on dentistry. Now, for me personally, I went from working 6 days a week, being burned out, because I went all in with real estate and passive investing. Now I work a very comfortable, very ideal schedule. I work 3 days a week. I gave up just starting in January of 2025. It's 5 months ago. I decided I don't want to work Mondays anymore, and I felt very comfortable to stop working Mondays. I had given up working Fridays. I had given up Saturdays a long time ago. And then I stopped working Fridays about a year and a half ago, and now I stopped doing Mondays. But I can comfortably have that optionality because I went all in with getting these investments that give me cash flow, right? I want to teach my fellow dentists that, because we get caught in everyone don't feel sorry for the doctor, the poor rich doctor. But guess what? Doctors get these golden handcuffs. They get stuck, because what happened to me was the income creep. I started making more money. I can afford better clothes now. I can afford a car. I never had a car until I was 20 years old. I can afford a car now. And my first car wasn't a Honda Accord. My first car was a Lexus, right? My second car was a Ferrari. I didn't even have anyone to tell me what I was doing was right or wrong. I just knew that I was making money, right? So then I moved to a beautiful apartment in Manhattan, deluxe apartment in the sky, right? So I was my expenses greatly went up, and the income creep came, and you get stuck. Then all of a sudden, if you want to work and then you depend on this income to maintain this lifestyle. Oh, private school for children, nice vacations. Or then you got to start cutting back. Or you have to keep working hard in order to maintain the lifestyle. That is one thing. There's one thing to be said about that. Never let that ever happen. But you can greatly decrease the need for this active income because we make great income as business owners, especially dentists that own their practices, make great income. And it's, hey, invest in your practice, but also take chips off the table, start building the income and wealth on the other side. Because once you do that and you focus with intentionality to build income from passive streams, this greatly opens the keys, the future of freedom, like true freedom. Hey, look, I don't have to work on Mondays and Fridays. This week I got a 4-day weekend every week, Rama. I look forward to that. It's awesome. That's the way I look at it. I get to now, and then that time I get to do this fund man. I get to do what I really love, which is being a fund manager. I love connecting with people that are interested in doing all of these things and finding strategies in the alternate space, in commercial real estate, other alternates. We love oil and gas. There's great tax benefit, W2 tax write-offs with oil and gas, which as high income earners, we want to mitigate that, right? So I started focusing on helping other people to get to where I got through 15 years, basically, right? 16 years, and fast forward that process. And I built a mastermind group for dentists. We have very high net worth dentists in there, very high level entrepreneurs, growth minded. That network has helped everybody grow. There's a synergy. It's flourishing. We bring vetted deals as a fund manager. We have a robust deal flow. We look at a lot of great deals. We have an incredible team that's doing due diligence. We have a chief investment officer now that Manish Podar. I think Rama, you probably know Manish. Yeah. He's a chief investment officer. He's probably one of the most prolific, sophisticated investors there is in the game. And so very proud to bring him on. And we're just trying to help a lot of people and do positive impact in the corner of the universe, my little tiny corner of the universe that I planted my flag, and dedicated my career at this point to serving.
Awesome. Thank you very much. And you invested in multiple asset classes. And Some went well, some didn't. That's what you said, right? Which asset class went really well? Which asset class didn't went not good? And what are some lessons from them?
Yeah, on the active side, oh geez, the mistakes, I would say the mistakes weren't more based on asset class, but it was based on my thesis at the time. My father, God bless him and I have no ingratitude for him at all because I wouldn't be here without him. He's a pioneer that came from Sri Lanka he grew up without shoes and didn't go to proper schools. And my father did a lot, and he gave us the entrepreneurial spirit. He put us in a position to have an opportunity, go get good education, which we did. But he also, like I said, just stumbled into real estate, and he happened to do well on a couple of deals. And he told me, "Hey, look, you should go focus on small towns because buy properties in small towns because there's no competition." And I can afford it. In Manhattan, I cannot afford to do anything, right? Like a strip mall with just 4 stores is still like $8 million, right? Okay, and I'm trying to come up with 25% of that. I just graduated and I have student loans. It's okay. For me to save up $2 million, not going to happen anytime soon. So I started, and I was working as an endodontist, but I got an offer from a company in Pennsylvania that had multiple offices, and there's no endodontists in Northeast Pennsylvania, or very few. There's a dearth of endodontists, and they gave me an offer I can't refuse. So I started commuting to Pennsylvania, and I would work 2 or 3 days a week in Pennsylvania and stay in a hotel, and because I was getting double the income that I was making in New York. And like I said, at that time, didn't have kids, and it was, hey, look, I start grinding and working hard and have energy, and you're young, and so all of that. I found stuff in small towns, and I used to work in the town, but instead of going and staying in the hotel after I finished the day of work, and I would go to a hotel and then go to the next town the next day, and then go stay in a hotel and then go to another town, all within the same region, and I would hit 3 offices in a sort of small geographic region, and then I would come back home. But instead of going to the hotel, I would go and drive the streets looking for real estate to buy, right? Hey, I'm looking for parking lots, and I'd find a parking lot, try to find the owner, do a title search. These are stuff my dad did. And I found a parking lot just by going and doing it. And it worked out good. And then what I learned about small towns, yeah, there's no competition and you got high cap rates. But guess what? It's also very hard to sell. And that's why their cap rates are so high. Right? Because there's no buyers there. Also, if you lose a tenant in a strip mall, again, you're in a small town with a aged population. So I had no idea about doing market research, all that. It's very difficult. Businesses don't come and go as they do in a primary or secondary market. This is a tertiary market. And I learned a very hard lesson of going into small towns is that it's hard to lease. And then so I had the anchor tenant of the strip mall leave, and it took almost, I think, 3 or almost took 2.5 years just to find another tenant to go into that anchor, right? So during that whole time, it's like I had the other 3 tenants that were covering, and it was basically break even.
Yeah.
But that tenant was basically supposed, and so I had to sell that property. I ended up selling that property at a loss. The other thing is I stopped going to Pennsylvania. I stopped working once my children were born. I wasn't staying in hotels and stuff anymore. I started working locally, and I found jobs in New York and New Jersey that were very close, and I could still earn the same income. Now I've matured in the dentistry game. My skills have gotten better. I've become more efficient. And I'm a very good endodontist, right? After that, I was not even going to Pennsylvania. So now I'm managing from New York, right? I'm a slumlord that doesn't care about this small strip mall because I don't go there anymore. It's not worth my time really because it's a small property, very small streams of income. I'm like, as long as it's covering whatever. I couldn't find a property manager. There's no property managers in that small town, right? It wasn't even a city. It wasn't even a city. It was a small town. So this property management, it wasn't a sophisticated real estate environment even. The property managers didn't exist. These are guys that they own a gas station and they work at the gas station. This is the type of small town it is. Like they just sit they're pumping gas. They own the gas station. Real mom and pop. Huge mistake. That was probably the biggest mistake. I lost 6 figures on that deal, probably about $150,000 I lost on that deal. But It was $150,000, but I gained a wealth of information, a little knowledge, right? Like I learned about triple net leases. I negotiated with Subway. I learned about property management. I learned about retail property. I learned about markets, right? I learned the hard way about how important where the property is located, right? So these are things that I started learning, and it made me realize the things, how much I didn't know, right? This is what was a wake-up call for me. And that's when I realized that, hey, look, you got to surround yourself with mentors. You need guidance. You need to have much better knowledge. So this led me to discover podcasts. I started reading. At the time, podcasts even didn't exist that time, right? 2008, 2009. Audible, I don't even know if Audible was out there. There were like podcasts weren't out, YouTube videos weren't out there like this, right? So now there's there's overload of information nowadays, but back then there was no sources of information. But I just engrossed myself in this world of podcasts and conferences, mastermind groups. I paid over $100,000 in different mastermind groups, easily over $100,000 in different mastermind groups. Surrounded myself with consultants, guidance, advisors, right? We have a whole teams now. Learned the ins and outs of due diligence and underwriting. But all of that wouldn't have happened if I would have sold that strip mall and made $1 million on it.
Yeah.
Say I bought that strip mall and I made $1 million. The success would have blinded me to all of my ignorance. Success is a lousy teacher. And I'm glad that I don't even call them losses. I'm glad I had these lessons that I paid for with blood, sweat, hair, everything. But it's made me who I am today as an investor, right? And much more cautious, much more risk mitigated, much more sophisticated. Yeah, so it was worth it though. But yeah, so anyway, to answer long answer to your question is yes. I would say that was the biggest loss. And that thesis of investing in small towns led me to a couple other properties too. I ended up doing okay on the parking lot. That was in a small town. It ended up being the parking lot that's across the street from the only movie theater in the city or little town. And so that was always full because everybody went to the movies parked there.
Yeah.
So that one ended up being okay. I had another industrial building, same thing. A warehouse, industrial land warehouse, the same thing. We ended up doing okay.
Yeah.
Nothing to brag about. Still made a little bit of money, got our equity back. And that's what gave me and then the houses, believe it or not, did better. The residential properties did better than some of these commercial properties, right? Oh, in the long run, because the appreciation had happened over 8 years and 8 years.
Yeah.
And real estate was going up at the time. So got fortunate there. And I eventually got all that equity, all my capital return, and moved into these passive investments.
Yeah, I can correlate some of this my initial investings like that. So if you enter into tertiary market, entering is easy, but exit is the challenge, and after a little bit slower compared to primary and secondary markets. Yeah.
Yeah, exactly.
Thank you. So how do you approach real estate investing strategy today, especially when evaluating deals in a high interest rate, uncertain markets?
This uncertainty has created a great decrease in volume of investments, tariffs, and all of the cost of inputs going up. Hey, cost of timber, cost of steel, all these things that are potentially all the inputs to build real estate going up. It's created a lot of uncertainty, right? Created a lot of pause. But having gone through a couple of recessions myself, I'm starting to understand how these cycles work. I realize and I see that this is one of the best times to get started with investing when nobody else is paying attention anymore, or anytime there's pause, right? When everyone's sitting and waiting on the sidelines to see what happens, is usually exactly when the best deals are out there to be made, right? The best deals are out there to be had. And yeah, I think this is a prime time to look at investments because this artificially manipulated metric of interest rates, right? 10-year treasury is what we're most interested in, mostly in the commercial real estate space. This is all dictated by the feds, really the bond market. So this is it's artificially manipulated, right? This number can go up and down, and real estate values go up and down with it, right? As a function of cap rate. Cap rates typically move not in lockstep, but move generally with interest rates. And so if you can get properties to cash flow at today's terms, you've mitigated that risk anyway, right? For the interest rate risk, unless you foresee potential interest rates spiking more. And potentially interest rates could go up, right? With tariffs, potential inflation, and we have no choice but to raise interest rates. So this is a possibility. And so this should be baked into your debt strategy, right? Anytime you are approaching a deal, one of the key areas we're looking at, besides the asset, besides the operator, besides the market, is we're looking at the debt structure.
Yeah.
That is usually the 90% of deals that have distress, it's something related to debt. And so by really evaluating the debt, making sure that it's mitigating for, hey, is there rate caps in place? Are there things that we need to safeguard and mitigate risk on the debt side? And is this debt structure appropriate for this deal and for the business plan of that deal, right? So that's what we're looking at on the debt side. And that, I think if you're really mitigating that, being able to have positive leverage, there's a cash flow is very important for me as an investor. I'm not looking so much at any development stuff currently because there's too much risk right now. We don't know what's going to happen a year and a half from now, right? We don't know what's going to have to happen to pro forma rents. We don't know what's going to happen. So there's a lot of, can people afford, right? Like rental increases. So these are the type of things you have to take a deep dive into on a market level. But if you are able to get deals that have favorable debt structure, favorable terms and basis, this is where fortunes will be made.
Yeah.
I think there's a lot of money to be made. Current environments, right?
Yeah. Awesome. Thank you very much. You're touching very good points there. Yeah. What's your approach to scaling? How do you grow without losing sight of quality, efficiency, or alignment with your long-term vision?
Yeah, we are a boutique investment company. We aren't bound by any type of quotas, or we are we know what we're looking for in deals, right? And we're pretty strict about that. And so we have a robust deal flow, and 90% of the deal, for example, I looked at 97 deals last year. We brought 5 deals to investors. So less than 6% we brought to investors. So it's not that we don't have deals out there. There's lots of deals out there, but I'm looking at I have a long-term vision. My goal is to help people to build income streams, to build wealth, and ultimately achieve financial freedom. Our mission at Walk of Wealth, I forgot to tell you back then, is to help 1,000 dentists achieve financial freedom through passive investments. That's it. We stick to that mantra. Everything we're trying to do has to be congruent with the overall mission. If we are compromising on the quality of the deals that we bring to investors, then that hurts that long-term vision. So I would never do anything. So when we're very intentional about deals. The deals have to be truly exciting deals. Otherwise, we don't do it, right? And that's just the nature of it. So we did 5 deals last year, just to give you a timeline. The first deal of 2024, we didn't do until April, right? Because January, the first quarter, we didn't do a single deal because we didn't find anything that we're trying to build a long-term track record. We're trying to bring long-term wealth for people. And so if we don't find anything great and exciting, then we just don't do the deal. So we did 1 deal in April. Then May went by, June went by, July went by, August went by. We still didn't have another deal. Oh, sorry. July went by, another 4 months went by. Then August, we found a great deal. September, we did a great deal. October, we did a great deal. And December, we did 1 more deal, oil and gas deal. Right before the end of the year, we wanted to get people 2024 write-ups. You get, with oil and gas, you get 80 to 90% depreciation in the year of investment. We were in the last part of the year, December. Last deal, we did 1 more deal. So the last quarter, we did 3 deals. Right? So Q1, we did none. Q2, we did 1. Q3, we did 1. Q4, we did 3. And there's no rhyme or reason to it. And now here, fast forward to 2025, we've done 2 deals in the first 5 months.
Yeah.
The first 5 months, we've done 2 deals. And we've looked at, I don't know how many deals we've looked at this year. I have the number. I have to just look it up on the spreadsheet because we keep track of all the deals that we look at.
Yeah.
And that we just turned down. We looked at 2 deals that we were looking at a debt fund. We were looking at a build to rent opportunity, which we ultimately passed on because of the cash flow and we were trying to stay away from development deals. But yeah, so we don't compromise on quality ever, right? These investments have to be very solid, have to be well risk mitigated, and that's the only way that we do it.
Awesome. Awesome. Thank you very much. So let's shift towards personal side. Any personal habits that are helping you to be successful?
Personal habits, shoot. Personal habits. Let me think. Some of the things that I've done is I've time blocked. I've learned about time blocking. So before I would just have investor calls, I had my Calendly open every day. Hey, Monday, Friday, call me anytime, man. Saturday, Sunday too. And then calls with operators, and then calls with potential, with investors, calls with sponsors, different sponsors, and doing podcasts. And it was just everywhere, all the time. It was just, hey, random times. And that made it very difficult to have any real chunks of time of focused energy, and you become a chicken without a head. So I learned about time blocking, and then so now I do all my calls on Fridays, right? So I try to do all my calls on Fridays. I do any recording podcast. This one is a little bit more of an exception to the rule. But most podcasts, and I have my YouTube channel, I record weekly videos. I do all recordings on Monday mornings. It's blocked out from 8 to 12. I don't do anything else. Don't book no meetings, don't book anything. That block is dedicated to that. And I find that when you create a block time, you can just lock in and focus on that one thing, and you can get a lot of work done. Because imagine if you had, hey, 8 o'clock, I'm going to go 8 to 12, I'm going to record, but at 10 o'clock, I have a podcast. I'm going to record a podcast on somebody's podcast channel. So I got at 10 to 10:30. And then I have another meeting a phone call meeting with my marketing team at 12:30 to 1 o'clock. So there's 2 half-an-hour breaks in there. And hey, look, I can squeeze these in. But once you do that, you cut off that focused energy, right? Like when you lock into one subject and you know that you turn off your phone, you don't have anything else to do, and you know exactly what you're doing in that time block, then you get a lot of work done in that time. You can become very efficient rather than have your thoughts and then break it up, get into a podcast. Then it takes you another 15, 20 minutes to figure out where you were at, get back into the zone and start getting the momentum. Next thing you know, it's time for the next call already, and you break your concentration and momentum again. So by time blocking, that's become great. It's also become better for my family life because now, hey, I don't have a call. Hey guys, I gotta leave dinner table early because I have to go do a call, or I have to go do this, do that. Now it's time blocks for family time. Hey, look, during this time, this is phones off. This is dedicated to only family time. So time blocking has been a game changer for me on a personal side, for sure. Yeah.
Awesome. Yeah. Any books that impacted you?
What kind of books you want? You want business books? You want personal development books? I'm constantly reading, constantly listening to audiobooks, constantly listening to everything. I'm always consuming YouTube videos, all kinds of stuff.
Yeah. Any one book that impacted you?
I mean, I don't want to give the cliche rich dad, poor dad, and cash flow quadrant. I know everyone gives that boring answer. So that is obviously a very influential book. Let me think of another book let me look at
Any recent book that you are reading or listening?
That I've read, yeah. I'm listening to a really interesting one now called The Psychology of Money. I'll tell you what, the ones that Blue Ocean Strategy is another great book that I'm listening to right now. On a personal level, I love economics. Genghis Khan's biography. What was it called? I don't even have it here, man. I'm sorry. I wish I would have been prepared for this question, but yeah, The Psychology of Money is a good one right now that I would say current book that I would very much recommend to anybody that's an investor. It's absolutely, it's a very mind-blowing, right? So you think about concepts about investing in a very different way. And we're all subject to the psychology of money. So no matter how much of a analytical, sophisticated investor that you think you are, So it's by Morgan Housel. So I would definitely recommend that book for any
Yeah.
investor, anybody that's an investor of any kind,
Yeah.
Psychology of Money. Yeah.
Yes, that's a great book. Yeah. Thank you very much.
Yeah.
So how can listeners can connect with you, Johnny?
Yeah, I'm pretty easy to find. My YouTube channel. Well, connecting, I have a walkofwealth.com. So it's WALK of wealth, WEALTH, walkofwealth.com. That's our website. You can schedule calls with myself or one of our teammates. We have a YouTube channel. It's also called it's called Walk of Wealth. If you just search Walk of Wealth YouTube channel. For any dentists that may be listening, we also have a private Facebook group called Financial Freedom for Dentists. So you can just go into Facebook, go into search, type in Financial Freedom for Dentists. We have 2,500 dentists there. That's a great place to talk to me directly, talk to other dentists that are also in the same boat as us, all trying to build wealth through passive investment. Yeah, so I would say that's the best way.
Awesome. Awesome. And thank you very much, Johnny. Thank you.
Thank you, Rama, for having me. It's been a pleasure.
Sure.